Yeah, I love charts, and I've been in the space for quite some time, as ASX has alluded to. So what I normally do on a Thursday is I take the MTM students through a bit of a sort of global market overview. So we have a look at what's happened for the week. We look at any sort of key changes. We start off looking at the DXY, looking at the US markets. We then sort of look at break down the US markets and sort of look in a bit more depth, check under the hood. And then we look at commodities and we look at crypto, we look at the Australian markets. So I'm going to take you through a bit of a market scan, a bit of an overview of global markets. And as we sort of go through, if you've got any questions, shout out. But other than that, please keep yourselves on mute in respect to everybody else. But I will keep an eye on the chat. So if there's stuff that's coming up, I will sort of attend to it. So I'll share my screen here. Sorry. Got a few overlapping screens I'm sorting out. Right, share. All right, so what I've got in front of us here is the DXY. So the DXY, for the people that don't know it, is the US dollar currency index. So the US dollar currency index is the strength of the US dollar measured against six other global currencies. And this is significantly impacted by expectations of interest rates from the US Fed and what they do with interest rates. Because when the interest rates in America are higher than the rest of the world, the strength of the US dollar becomes, increasingly stronger. And as we start looking at rate cuts, we should start to see the US dollar start to break down. Now, what we have seen here is we've seen this big sort of growth of the US dollar through the liquidity cycle and then into higher rates. If I go and overlay the bond yield, this is the sort of 2-year bond yield. And you can see as interest rates go up, so the US 2-year is really closely linked to what the Fed interest rate is. So as interest rates go up, you see the US dollar strengthen against the other currencies. As you start seeing it plateau and as you start to see other countries starting to pay catch up and putting their rates up, you started to see the US dollar sort of stabilize. But it's only come down a fraction of what it's gone up. So it's still sitting in this range, and it's been sitting in this range now for the last sort of 18 months, between sort of 101 and 106. Now, there is a very significant correlation between the US dollar and the markets. And this correlation exists for two reasons. One is anything that is priced in US dollars, when the US dollar strengthens relative, that loses value against the dollar. And secondly, this is an opportunity cost. So when interest rates are high, people sit in cash and sit in money markets and get really good returns. Whereas when interest rates drop, their money's no good in banks or in money markets. So they want to put it into investment instruments and put it into other asset classes. So where we are sitting at this moment of time is we're sitting at a really, really key level, or in a key range here between 104 and 106. And why this is so key is this is the range that we've sort of been in for the last few months. And if I move it to the daily, you can see how we've been ranging in here. If we break out above this level of 106.5, that becomes exceptionally bearish for markets. So bearish for cryptocurrencies, bearish for equities, and bearish for commodities. If we break down below the support of 104, that becomes exceptionally bullish for commodities, equities, and cryptos. So as traders or people that want to see equity prices, cryptocurrency prices, or commodity prices going up, we really want to see this breakdown. So tonight is incredibly important because tonight is the US CPI print, and there's a real expectation that CPI will come down. Now, I've drawn a bit of trueflation data, And what we look at with trueflation is trueflation, similar to the Fed, measure a basket of goods all the time. Now, trueflation's results come in slightly, that they measure a different basket of goods. They measure a much bigger basket of goods than what the Fed data measures. But what we look at from a trueflation perspective is they have seen a very similar pattern to the Fed. So even though their percentage isn't the same as the Fed basket, we get a really good feel from trueflation of what to expect for the Fed's figure. And what you can see here is we were sort of pumped up last year. This is a 12-month graph. So we topped out in October. We then came really nicely down to January. And then from Feb, we started to see sticky inflation, and we sort of saw inflation come back. And now we're starting to see inflation drop again. It dropped and then went back up again in May, and May came out, April, May sort of sat sticky at 2.5, 2.5, and the Fed figures came in at sort of 3.4, 3.3. But from about the 15th of June, we've already seen inflation take us a massive drop off, according to the trueflation data. So if that gives us a guide of what to expect, and if trueflation figure has gone from 2.5, 2.4 to 2.1, we could see a similar a 3 or a 3.1, a 3, or possibly even a 2.9 tonight, which should theoretically be very good for the markets. Now, the one other thing that we need to look at is what are the sort of rate cuts and what are the expectations that feed into the bond yields and also feed into the DXY. So when we look at the market, sort of puts a probability, and this is available on the CME FedWatch tool. This is the sort of expectation right now of what the Fed will do with rate cuts. Now, once the CPI data comes through tonight, this over the next 24, 48, 30, 72 hours will change and will update and show a change in expectations. Now, if the CPI number is higher than expected, this will get worse. And if the CPI is better than expected, this will get better. So currently we're looking at, current rate is 5.25 to 5.5%. The expectation for July is that we will not have a rate cut, that we will stay at our current rate. There's a 95% chance of us staying at the current rate. There's a 74% chance that we will see a 0.25% rate cut, a 25 basis point rate cut in September. Then there's either September or November. And then there's another 25 basis points expected by December. And then as we go into next year, there's another rate cut either January or March, again in April, and then either June or July. So there potentially could be 1, 2, 3, 4, 5 rate cuts over the next sort of year, which would significantly stimulate the market. So the CPI print tonight is going to be incredibly important to see what happens to markets. When we look at the S&P 500, and we're going to start with the US markets, I set this target at the beginning of this year. So about 6 months ago, I set this target based on where we were with the US markets and where we were based on all of the similar. So I took out the 2020 crash and I took out the 2008 crash. But the rest of the election years, I have left in here, and I've sort of mapped out the trajectory that the S&P 500 has enjoyed over election years, because it is a very, very similar cycle to what we get. And what we've seen this year is we have completely outperformed the first 6 months of any other election year. What we've seen is Q1 we saw was very similar to what we had seen in previous election years. In Q2, we started pulling back like a normal Q2 would, but our Q2 pullback was really short-lived, and we started to bounce from there. So I had this as a range target between 5,500 and 5,900 for the S&P 500, but I expected to get there halfway through Q3. So we are 6 or 8 weeks ahead of schedule to where I thought that we were going to get into this range. But we are here now, and now we need to sort of understand, where do we go from here? In election years, we get this really big pullback in the 6 weeks coming into the election. The markets don't like uncertainty. So this big sort of pullback is markets not liking uncertainty and selling into uncertainty. As soon as the president is elected, from there we start to see a really good. Sorry, somebody who's drawn on the. Thanks, Andrew. We generally see a really strong first year term of the president, and so what we expect to see is a pullback at some stage. Whether that pullback happens in Q3 or whether the pullback happens in the beginning of Q4, we would expect to see a pullback. Looking at cyclical bull markets historically for the S&P 500 normally last between 30 and 34 months. We're currently 20 months in from the October 22 low. So we've been in for 20 months, which ideally would say that there's another sort of 10 to 14 months left of this bull market. However, within these bull markets, we would normally experience 2 healthy pullbacks per year. We've had one, and that one pullback was just over 5%. We normally expect 2, and we normally expect the bigger one of the 2 to be about a 10% pullback. So if we look at being at 5,600, a 10% pullback would take us to 5,000 or 5,100. Whether that happens in Q3 or whether that happens in Q4 remains to be seen. But we would definitely expect to have approximately a 10% pullback sometime in the next sort of 4 to 5 months. Just as this pullback was a great buy the dip opportunity, the next one should also offer a really good buy the dip opportunity, considering where we think that we will go over the next sort of 18 months from here. For people that are looking at it from a more sort of holistic perspective, we've spoken about this quite at length with MTN in the last 10 weeks. But where we are in terms of a liquidity cycle, there's an 18.6-year property cycle or investment cycle. We've also looked at the Benner cycle. There's quite a few cycles that we work to. This particular cycle that I've got up on the screen is the election cycle, but markets always tend to go in cycles. And when we look at the 18-year property cycle, the last big crash we had was 2008 into 2009. If you add on 18 years from there, it takes you into 2026. And everything seems to be aligning, and we've driven at the moment in a bit of an AI bubble. And we've all, unless you've been living under a rock, you all have heard about NVIDIA and the 1,000% growth that NVIDIA's had over the last sort of year and a half. And this AI bubble, when people start talking about bubble, that's probably not when it's going to burst. It's when everybody thinks and euphoria sets in, and they stop talking about bubbles. That's normally when the bubble does eventually end. But what we're looking at is we're in a cyclical bull market. We have a property cycle that's looking like it would top out in about 2026. And where we are with expectations around markets is that we've probably got another 12 to 18 months before we end up facing an incredibly strong headache. When we look at the S&P 500 and we look at a bit of stats in terms of, this is the forward PE ratio. So this is the price to earnings ratio of companies in the S&P 500, the average. We're currently sitting at 21. Before we topped at the end of 2021, we got to 23. And just before we had the dot-com bubble, we were at about 24.5. So we are getting up to the top end of a price to earnings ratio. And that's something that we need to sort of keep an eye on because, when you start to get over 22, 23, you're getting into that territory where stocks are incredibly overpriced. And that's normally when a pullback is expected. The big thing that starts this week, the big thing that starts tomorrow is banks start reporting. So we have quite a few big banks starting to report tomorrow. We then carry on with banks next week, and then we start going into the big tech companies and everything else. This is going to be an incredibly important earnings season throughout this month. And the reason for, I've just spoken about the price to earnings ratios, and what we need to see is we need to see these companies deliver profit. There's huge expectations going into these earnings seasons, and we've seen some really good performances, and we've seen this really strong performance out of the S&P 500. But we're really starting to what the investors want to see is that their confidence in stocks are actually being met with really good results. So this is just a chart of the most anticipated earnings. And, we've got some big companies here like Netflix next week, and we've got Tesla coming up. We've got IBM, we got all of the big companies, Meta, coming up over the next 3 weeks. So the next 3 weeks is going to be incredibly volatile. And if you look at what puts and calls are sitting there, these types of results can result in 10 to 15% swings on a stock in a day, depending on what their outcome is. And this generally sets the tone in terms of whether investors and traders are going to take a risk on or a risk off approach. Moving into a little bit about liquidity. So what I've got over here in this gray chart over here is what we call global M2 money supply. And global M2 money supply is all of the cash and all of the investment money, all of the sort of accessible money globally available. And what we tend to see is we tend to see global money going through ebbs and troughs, ebbs and flows, and it has a significant impact on the market. I've charted 3 things up here. The white chart is the S&P 500. The yellow chart is gold, and the orange chart is Bitcoin. And when we start to look at periods where M2 money supply is positive, you can see how, irrespective if we're talking equities, if we're talking gold, or we're talking Bitcoin, how it drives that massive increase in price in all of those sort of asset classes. When we start seeing periods of decline in global M2 money supply or in decline, we start to see how the bear markets happen. And these all coincide with the big bear markets that we have. And then after the COVID crash, this big spike down was a COVID crash, you can see the amount of liquidity that central banks and governments put into the economy. And that drove the next sort of cycle where, Bitcoin topped, and there was a massive move across the S&P 500 and all global markets. Then we went into a period where global liquidity got taken out. So the Fed tightened. They went into quantitative tightening. They removed money from the markets, and they also increased interest rates, which cut down people's ability and savings, and it cut down the M2 money supply. So we started to see all 3 asset classes starting to crash. Then we had a period in 2022 when the banks collapsed. And what happened is when the banks collapsed, the Fed stepped in and started to provide liquidity into the market to bail out the banks. And that immediately pushed all the markets, and that took Bitcoin out of its bottom of its bear market, and it started the rally, this big bull run that the S&P is on, that started in 2022. So once again, we had a bit of a dry up over here. And that's when Bitcoin was sitting at that 25 to 32,000. We started to see gold coming off. We started to see the S&P having their 5% pullback, right? And that all happened as the money supply ran out. And then what's been happening since is money supply came back in January this year, and that has fueled the next stage of this run. So we've now sort of bottomed out, and we're starting to see at the bottom, this is year on year change. So you can start to see that after being flat, we're starting to see a little bit of a positive again. And if we start rate cuts, if the Fed start rate cuts, we will see this global liquidity starting to increase because the American M2 money supply is a very, very large percentage of the global M2 money supply. So where we've got is we sort of flatlining here. What is the only sort of asset class that is behaving according to M2 money supply right now is gold, where gold's been sort of consolidating at a range. S&P's carried on its very extensive trajectory, and Bitcoin has had a significant pullback. So what's going to be important is if we're going to go back into a liquidity cycle now, which definitely looks like it should happen, the Fed's mandate is to control inflation and to protect the workforce. We've seen the unemployment rate go from 3.5% up to 4%, up to 4.1 last month. So the Fed is now getting to a stage where they're going to have to start acting to protect the labor force. And we're also starting to see inflation starting to come down, and we're hoping to be at 3% tonight, or maybe even better than 3%. So the expectation for tonight is 3.1. Last month was 3.3. If we come in at 3.1 or better, that will be really positive for the markets. But the one thing that we do have to take into account is we have come off an incredibly high base of inflation, and we're starting to now get really good figures, because in October, November, and December last year, US inflation actually became quite sticky and started to reverse and started to go up. We are now going to cycle on that year on year. So the Fed's going to be more interested in the month on month increase, and the target for that is 0.1% rather than the year on year figure. So that might throw the markets tonight. If we come in at 2.9 or 3% year on year, which would look incredibly good for the markets, but we come in at 0.2 or 0.3 month on month, then the Fed are going to take that really poorly, because they're more interested in the month on month right now, where the market thinks they'll be positive, and you'll then see a big reaction at a 2.9%, and then an opposite reaction probably 2-3 hours later, when they start digesting it and realizing that the month to month is quite high. So the month to month, and I'm not sure what the month to month will come in at, but what the expectation is total CPI month on month expectation is 0.1%. So we hope to see a 0.1% or possibly even a 0.0%, so no growth month on month, and that would be incredibly bullish for the markets. Just diving in a little bit deeper into the S&P 500. The S&P 500 is made up, of 500 stocks. But I like to sometimes use what we call the RSP ETF, which is the S&P equally weighted ETF, and that's the green line I've got in here. And what that takes is the same 500 companies, but weights them equally, so that the mega caps don't sort of sway the S&P number. And when you look at that, we've really seen divergence. So yes, the NASDAQ and the S&P 500 has outperformed the Dow Jones, has outperformed the equal weighted, it's outperformed the Russell, which are all the sort of middle and small caps. But what the biggest concern is actually from the 29th of May, it hasn't only outperformed, we've actually had divergence. So the S&P 500 and the NASDAQ have continued to climb to new highs, whereas the equal weighted, the Dow Jones Transportational Index and the Russell, which are 2,000 stocks, the RWM, have actually all gone, have put in lower lows and lower highs. So there's a first sort of sickness in the market that really shows us that even though we're in this massive bull run, we're in a very concentrated market. The breadth across the market isn't there. We're definitely seeing that there's a big appetite to invest into the Magnificent Seven, the mega caps, but there isn't the same appetite to invest into large, medium, and small caps. What is really promising is if we start to look at this on a more recent basis. In the last week, we've started to see Jerome Powell being quite sort of dovish, talking that he needs a bit more data, but he's really talking that a September rate cut is a real possibility. We're also starting to see, a week and a half ago, we had the 4.1% unemployment figure. So people are starting to think that rate cuts are a very, very high probability, which is backed up with the data that I showed you in terms of there's a 76% chance of the first rate cut by September. And what you're starting to see is because people are starting to think that interest rates are going to come down, we're starting to see more risk come into the markets. And when I say that is this is just the last 2 weeks of the exact same charts that I was looking at. So the NASDAQ, the S&P, the Dow Jones, the IWM, which is the Russell 2000, and the green equally weighted S&P. And what you can see is they're all starting to turn up this week because you're starting to see for the first time since April this year, you're starting to see money flowing into the medium caps and the smaller caps, which is a really healthy sign for the market. So if CPI comes in favorable tonight, we could see more money flowing into the mid caps and the small caps. And if we see more money flowing into the mid caps and the small caps, that could be an incredibly good sign for the health of the market, because at the moment, this big S&P 500 push that we've been having, being such a concentrated market with so few stocks that are actually making new highs, whilst the majority of other stocks are making lower highs, that's not healthy. That can't continue for a long time. But if we start seeing money flow out of mega caps into large caps and into mid caps and into small caps, that would then present us with a much healthier market. And that could then see us making more gains across here. It could sustain this run for a bit longer because this run seems to be topping out now. And I'm waiting for this to roll over. But if we start to see money flowing into the large, medium, and small caps, we could get a further, more sustainable run here. If we take that a little bit further and we look at all of the different sectors, we can definitely see, and this is from the 1st of June. So this is the last 5-6 weeks. We can see that the categories, the sectors that are leading are the risk on categories. Semiconductors, and I've called that out by itself, and normally it's incorporated in technology, but semiconductors is absolutely the star performer. Nvidia hit the $140 over here, had a pullback, and now Nvidia is sitting, ranging, and consolidating for a while, which is healthy for Nvidia. But what we're starting to see now under semiconductors is we're starting to see AMD and Intel have huge gains as they start to play catch up. So, and this is exactly what I'm talking about, money flowing out of the mega caps into the medium caps, and starting to fuel a more balanced market. So if we can get more examples of money flowing into Intel and AMD for semiconductors, for an example, and we can see that happening across all of the markets, that would be incredibly healthy for us. But if we look at the categories, consumer discretionary, communications, technology are all leading, and that's a very risk-on environment. When you look at energy, materials, utilities, consumer staples, industrials, healthcare, or being at the bottom of the performance. Those are the more sort of defensive categories. So it's a definite true reflection that investment mindset right now is very risk on. And if rate cuts are confirmed, and if CPI comes in really cool tonight, we'll see even more risk start coming into the markets. When we look at the Magnificent Seven, and the Magnificent Seven have, since the October bottom, Tesla's absolutely had a horrendous run until the last 11 days, and they've had an 11-day winning streak recently. But the Tesla's really dropped off in market cap compared to all the rest. For the sake of this chart, I took out NVIDIA because if I put NVIDIA on this chart, I battled to see this. But if you look at from the bottom in October 22, Apple's up 53%, Amazon's up 74%, Google's up 96%, Microsoft's up 97%. Meta is having a phenomenal run, up 300%. And then I add NVIDIA into the chart, and NVIDIA is up 977% since the October lows. So there's been a real move, and this is where the money has gone, and this is why the S&P is looking so good, because these Magnificent Seven are really showing all the performance and hiding the non-performance of the smaller cap stocks. When I start looking at more recently, you can see this green line is Tesla, and they've just absolutely had a phenomenal run the last 11 days. I think they've gone from like 170 bucks to 240 or 260 bucks on share price. So, and this is one of these things with Tesla. When Tesla gets onto a sort of bearish trend, they stay bearish for a while, but when they start to turn, this is a great retail stock, and they just absolutely fly. So they've had a magnificent growth, and even though they've had this growth for 11 days straight, stats tell you that once they've had a good strong 10 days, they tend to continue to show slower gains, but still show gains for another 21 days beyond that. So I don't think that Tesla's run is over yet. Looking into commodities, commodities, metals are starting to really wake up. Metals have not really performed well, and this is copper. Copper, I like to call it. We call this Dr. Copper because it talks about the health of the economy, and when copper does well, it's a really good sign that the economy is strong. When copper is in decline, it's normally meaning that the home builders industry, everything else, and the rest of materials is really battling, and the economy is battling. So we started to see a really good performance of copper this year. So from the beginning of this year, we saw a phenomenal run on copper. And this was the pullback that had to happen. There were so many people in copper that it needed this healthy pullback. It's had a healthy pullback, and then had a really strong bounce. What we're starting to see in the rest of materials is even on precious metals. Gold had its breakout, sitting in a beautiful consolidation now. Now we're waiting to see what's going to happen from here. This was the biggest move that gold has had in a very, very, very long time. Gold has sat in a 4-year consolidation under 2,000. So to break out above 2,000 and not only sort of sit at 2,000 but go up to 2,400, it's healthy to consolidate here for a while, and we're looking for this responds incredibly well. Gold and silver responds really, really well with interest rates. So if I throw on the US 2-year, which was the same one I had on the DXY, and we start to, sorry, let me just new price scale, and we look at the correlation, that there's an inverse correlation. So as interest rates go up, gold drops. As interest rates come down, gold rallies. As interest rates go up, gold drops. As interest rates come down, gold rallies, right? So if if interest rates are going to start coming down again, if we do start rate cuts in September, this gold is going to have a phenomenal 12 to 18 months during that rate cutting cycle. So, we haven't seen any good movement on gold for a very long time. I've got a target of $3,000 an ounce for gold. We're sitting at just under 2,400 now. The one big thing that we're going to, if gold does rally by another $500, the one thing that we want to keep an eye on is our gold miners. So if we look at GDX, we start looking at GDX and how GDX is really lacking behind the gold price. So what's going to happen is if gold continues to run, gold miners don't only pick up this lag, but gold miners actually make a lot more profit margin. When the price of gold goes up and their costs remain the same, their profit margins multiply. So GDX, which is the gold miners ETF, which is pretty much showing you where the gold miners stocks are sitting, there is a big catch up to be done. So I'm bullish on gold, incredibly bullish on gold for the next 12 to 18 months. And if I'm bullish on gold, then you've got to be bullish on gold miners because, this gap, firstly, is an opportunity. But when that extra profit margin starts kicking into those gold miners, there's going to be some really lucrative stocks to be in gold. Also looking at commodities, oil is an interesting one. This one's really important because this has an impact on inflation. It also has a really big impact on the energy sector. So where we are sitting, and we saw horrendous figures in 2022 in terms of what oil prices got to, and we all saw what that did to the prices of petrol at the pumps. We had a massive sell-off, which has definitely, if I put in XEJ, the energy sector, we start looking at the fall off of the oil price and how that has come back, especially sort of from here. And you look at the impact that has had on the energy sector. Now, the energy sector should have quite bottomed by now. And if that's bottomed, it's a great opportunity. And at MTM, we've been speaking quite a lot about great energy stocks, both coal energy stocks and also clean energy stocks to start looking and getting into. Because as certain things like the S&P 500 and the Magnificent Seven might appear expensive when you're looking at the price to earnings ratio, there's other sectors or asset classes like energy stocks and other commodities that are really well priced now. So a good opportunity to have a look at your sectors and look at what sectors you want to rotate into. And energy is one that we are keeping an eye on. And it's really going to be interesting to see what the CPI numbers do to commodity prices, including petrol prices. So oil prices, sorry. So this is at a key level. We've sort of got this range over here between 80 and 81. Above that is sort of bullish for oil. Below that is quite bearish for oil. We're sitting down. We tested that last week and sort of bounced back. Got quite a strong buying reaction. This is where the buyers should step in. When we were down here in MTN, we discussed a few weeks ago that we were aiming it to get to 84. It hit 84, got rejected, but then found buyers coming in again at 81. So we're keeping a close eye on what happens to oil. Looking closer to home, XJO. So the ASX. The ASX is a very different market to the American market. The American market is really heavy in technology. The ASX is really heavy in sort of industrials, materials, financials. So what we are more likely aligned, we're more aligned with the FTSE, the London Exchange, in terms of the makeup. And when we start looking at cycles, the technology cycle has been incredibly strong since October 22, and the US markets have performed incredibly well over the last 18 months. They may start plateauing a little bit now, but now we're starting to look at energy, materials, commodities, all of these types of things where there's a great opportunity in terms of we should start seeing some really good growth coming through on the ASX. So where we are here is, we've been in this range and of having 7,600 as resistance for the ASX. And we've broken out there, we've consolidated above that, flipping resistance into support. And it's really about keeping an eye on where this is going to go now. The one thing that is holding it back is the inflation is quite sticky in Australia. So even though America seems to be winning their war on inflation, Australia is battling a little bit more. But if we hopefully will start to see this breaking out. Some of the key sectors in Australia is the financials. The financial sector has done exceptionally well. The financial sector has done incredibly well across the world, and that's why the reporting season kicking off tomorrow in the US, which start with all the big banks, could be a really bullish start to reporting to the earnings season. Banks at this stage are handing out credit left, right, and center. They're engaging their customers to take on loans. They're giving really big loans and very lucrative interest rates. But the interest rates that they're paying you on your savings account and checking account is virtually zero. So, you're sitting at 1.25%, but when you're taking out a loan, you're paying 8%, 10%, 12%, 14% on loans. So the financial sector is performing incredibly well. We're expecting to see some really good results come out from banks this week. And that's a sector that has absolutely been thriving for the past 12 months. What we need to see is where the uncertainty comes in, and when we're starting to see in Australia, we're starting to see the impact on retail and consumer spending now. So for the first sort of 8 to 12 months of rate hikes, we didn't really see the slowdown in consumer spending. We are starting to see that now since April. So April, May, and June have been the first sort of 3 months, the rolling quarter, that we've in retail starting to see consumer spending really start taking a hit. When we look at another sector that I mentioned earlier was materials. So materials, right, it's been sitting on this base of support for a period of time, and we're really looking at going into a sort of new high here. But the one that I was really excited about was that should be presenting a really good opportunity for us is energy. And if you look at energy, besides the COVID crash and how it battled to get back up above the support, energy has been ranging in this range since 2017. So we've got 7 years of consolidation in energy. So we're really looking to see if we can get a punch through here, breaking this trend line and starting to see some good moves on some energy stocks. Not too much on the rest of the things. I wanted to touch on cryptocurrency and Bitcoin. So Bitcoin's being quite topical at the moment and broken through the 200-day moving average. When we look at it on a weekly basis, we were quite concerned, and the bears were quite vocal when we started to hit this top, and we were starting to get weekly RSI levels above, close to 90, whereas previously our sort of tops have been about 94, 95. Getting to 87 is quite high for a mid-cycle top. So when we look at it into context of where we've been and we look at the weekly RSI levels, we can see that we had a mid-cycle top in June 2016, where we were at 84 on the weekly RSI. we had the mid-cycle top in June 2019, where our RSI on the weekly was sitting at 80, and we've now had our mid-cycle top in March this year, where we hit 87. We had a 40% pullback in 2016. We had a 53% pullback, and I'm not counting the COVID crash. This was the correction of the mid-cycle top that came back under the 200-day moving average, was a 53% pullback. And we've now had a 27% pullback. But the pleasing thing to see is this pullback brought our weekly RSI down to 53. This one pulled it all the way down to 39. And this one's pulled us down to 45, which is incredibly healthy. When we start looking at a key thing and we start looking at what does the post-halving consolidation period look like? If we look at where our pre-halving top was, and we look at where the halving was, and the period of time from the halving until we took out the pre-halving top, it was 161 days, 23 weeks, back in 2016. In 2020, it took 175 days, 25 weeks, to take out the pre-halving top. So far, we're only 77 days, 11 weeks past the halving. So if the previous cycles are anything to go by, and if you look at RSI levels, we pretty much aligned to the pullbacks on RSIs, then there was 25 weeks there, 26 weeks there, and we're only 11 weeks. We could potentially be sitting in this range for another 14 weeks before we actually have a breakout. Are we at the bottom? Well, if we look at it from a support and resistance perspective, right now, the biggest thing that we have done is we've lost the 20 moving average, the 200-day moving average, right? We are trying to get back above the 200-day moving average. And, that is absolutely key in terms of flipping that back into support. Now, we had a very similar pattern over here in August, September last year when we were stuck between 32K and 25K. And we sat under this 200-day moving average for quite a period of time before we broke back up. We sat here for 7 or 8 weeks before we broke back up above it. This presented a fabulous opportunity to buy. If we look at where we were on a weekly basis from an RSI perspective, over here, we were at a 46 level, and we're now at a 45 level. So we're actually at the same weekly RSI level now as what we were here before we had 100% pump up here, 20% pullback, and another 100% pump up. So from an RSI strength perspective and from a sort of a retracement being deep enough, we certainly tick the box. From a daily structure perspective, right, there's a couple of key things that we need to look at. Is we are sitting at the moment below the 200-day moving average, which is bearish. There is this big 60 to 61.6K, sorry, 59 to 61.5K. That is an incredibly strong support base that has now been flipped and now will serve as incredibly strong resistance. Whilst we are below this, there is definitely risk to the downside, right? What we need to see is we need to see that we break up, come back down like we did back in May, come back, retest this, flip it back into support, and then start to move up. A key pivot level that we have to take is 63.8K. That is a very, very key level. As long as we're below the 200-day moving average, below this key support and resistance, which ends at 61.5, and below 63.8, we've always got a risk that any bounce here is just going to be a lower high and another leg down. The next level of support sits between 50.4 and 52.5K. That would be the next target if we put in a lower high and we head down for one more sort of push. Below that, the next big target is between 40 and 44K. I personally have deployed some of my dry powder and bought at this range, but I am keeping a bit in reserve in case we tap this. I must admit that I'm seeing all the same signs that I saw back here at August, September last year, where everybody was calling for us to go back to 20K or possibly even to new lows. And the bulls violently defended 25K. And we came back and we dipped into 24.9. And then this was one of the most lucrative trading runs I've ever had. From 25K to 44K was one of the best and most lucrative trading runs I've had in crypto. So, the main thing is you need to prepare yourself for two strategies. One, what would you do if we go down? And two, if we break here, have you set yourself up for what happens further? When we look at where we are, this chart is a simple Bitcoin versus S&P 500. And the indicator I've got here is what we call the correlation coefficient. So this measures the periods of very above the green dots is highly correlated markets. And when we start to break down, going into inversely correlated markets. So, zero is there. So anything below that yellow line means it's inversely correlated. And these markets have always proved to be incredibly correlated historically. So periods of inverse correlation, when they actually lose their correlation and they work inversely with one another, are periods that we need to pay attention. And because something significant is going to change from there. And if we look at the periods that I've highlighted in yellow, are the periods where we lost correlation between the S&P 500 and Bitcoin. And we normally lose it for 92, 98, 84 days, 71 days. This period was incredibly long. This was last year. This was that range between 25 and 32. We were uncorrelated for 189 days. And so far, we've been uncorrelated now for 91 days. So we're at the average, but there is an example of double the time. But in terms of the other 4 periods, we're pretty much at that now. And what normally happens after this period of inverse correlation is one of 2 things, or one of 3 things. A, Bitcoin's going to have a strong recovery. B, S&P 500 is going to have a major correction. Or C, a bit of both. But and this is a great example. As you see, the S&P 500 correct while Bitcoin plays catch up. And then the correlation became really close again all the way through until it became uncorrelated again. So this is a great, and this is one of the things that we teach in MTN is market correlations, because it's really important and it's a really good early indicator of when to expect a market shift by looking at the correlation, or when a markets lose their correlation with one another. Looking a little bit at Bitcoin cycles, what I've done here is I've taken this chart. I'm just going to move this into a line chart. And I've aligned all of the different cycles, the Bitcoin cycles. So what I've got over here is, this is the first cycle from 2011 to 2014, sort of topped at 746 days. And then we had quite a long sort of bear market, a longer than usual bear market down. The teal color here was the 2015 to 2018 cycle. We were following this one most closely in terms of our current cycle. But if you look at where how we are tracking compared to this, is we actually still above both the 2015 2018 cycle and the 2019 to 2022 cycle. Now, if I open these up so you can actually see them a little bit clearer, I like to talk about mean reversion, because whatever happens, and one of our week's focuses in the 10-week program is the market discounts everything. So one of the things that you get is you get periods where the market pumps on news. And for an example, this big pump over here where we left the other fractals was on the Bitcoin ETF news. We outperformed and accelerated far beyond what the previous two cycles had seen. When we came to COVID in the 2020 dump, we broke away from the sort of mean line, went really low, and over time the market factors that in, and we come back to where we are. You can see this not only on the Bitcoin chart, but if you take the total crypto chart, I've done the same sort of thing. So this is total crypto. And this was the cycle bottom. This is aligning all three cycles bottoms. And what I've done here is I've drawn a line of what we call the mean reversion trend line. And what happens 2 or 3 times during the cycle, you'll find that all three of the cycles sort of merge and come back to this mean reversion trend line at roughly the same time in the cycle. So in 2020, we outperformed and then we came back. In 2016, we lagged and then we came back. This cycle here, we've outperformed with the Bitcoin ETFs and we've come back to the trend line. In 2020, we had the COVID crash. We came back to the trend line. And if we look at, irrespective of which year, which cycle you want to look at, similarly to Bitcoin taking 25 or 26 days from the halving before they actually really break out, in the previous cycles, we always sat around this mean reversion trend line, going out, coming back, going out, coming back, until we eventually left it and never looked back. And that point is about 15 weeks from now. That's the point that it happened in the other two cycles. So this is total crypto market cap. This is Bitcoin, this is Ethereum, and all the altcoins. But once again, it doesn't mean that it can't go up. It just means that we won't start what Raoul calls the banana zone. We won't see the banana zone until we're ready. And when we're ready, we're probably looking at sort of October. Looking at also just heading back to this Bitcoin one, looking at if we, and it's really good because when we were pumping up here and we were so far ahead of the other cycles, there was a lot of talk about a left translated cycle that we would top out a lot earlier than what we did with other cycles. This sort of mean reversion back to the previous cycles is giving us the confidence that this cycle isn't different and that we could have a similar time frame to work towards. And if you look at what that time frame is, it's about 3 years post the bottom. So, if you look at the last cycle, the 2021 top, it would align from time of the bottom to the November 2021 top. That will actually take us to the 13th of October 2025. And if you align the previous cycle, you're looking at roughly the 20th of October 2025. So far, looking at the crypto cycle and looking at where we are on the daily chart, the weekly chart, looking at where we are on against other cycles, looking at total crypto market cap, where we are against other cycles, there's nothing telling us yet that we should expect anything different to what we've seen in other cycles. We're on track of achieving the same. As soon as we start losing levels, or we start seeing RSI levels or being vastly different to what we've seen in previous cycles, we can start saying that things are looking different, and we need to start understanding what risk that presents. But at this stage, I'm seeing that these types of opportunities, and if I look back as far as I want to, in every time that we've gone and touched or gone below the 200-day moving average, would have always been really good buying opportunities. So whether you had bought here, whether you had bought here, whether you had bought the COVID dip, even in 2016, that was your sort of last big buying opportunity, because we never came back. So always understand that there is risk. There's no guarantees in life. At this stage, we are starting to see on the daily, though, some good bullish signs. So if I pull up the RSI on Bitcoin, you can see lower lows with higher lows on the RSI. We're showing bullish divergence here, right? What we just now need to see is we need to see those three really important levels be taken out. If we can get the 200-day moving average, and with a good CPI result, hopefully we break through that. Hopefully the next one is the 60.5K, 61K. We need to get through that. And then we need to take this key pivot level, call it 64K. When we're above 64K, that is definitely minimizes any further downside risk. And then the bulls are properly in charge when we take 66.7K, call it 67K. The bulls are properly in charge. The other good tool that I like to use is the volume profile. And if I use the volume profile on this, it really talks to where the key levels are. And these key levels, this is your value area low. And you can see how the value area low, which acts as a big resistance and support level on volume, aligns perfectly with our support and resistance levels. This is what we call the point of control, this red line, and that's sitting at 66.9K, which aligns perfectly with the support level that I said the bulls are firmly in control once we get above 67K. And it just shows you that the confluence you can get by using indicators and other tools really help your decision making. So am I bearish or bullish? At this level, with the RSI levels, with the bullish divergence, everything else, I'm cautiously bullish. But I'm cautiously bullish until we take out that key pivot level. Then I'm a lot more bullish, and I'm properly bullish once I'm above that red line of 67K. Just the last thing I'm going to touch on is Ethereum. Ethereum is also at a very critical level right now. So really good, strong double bottom. Ethereum held that low, which was really good, besides a couple of small weeks, but it held that low. So Ethereum showed a lot more strength than Bitcoin in this last pullback. But at that value area low and at the 200-day moving average, and it looks like it's going to punch through. And if that punches through, that's really positive. Also, the news of there's expectations that next week Ethereum might be approved to start trading as an Ethereum spot ETF. We saw the big pump up here on the news that it got approved by the SEC, but it hadn't yet been approved for trading. We're now just waiting for their S1s to be approved, which hopefully that will be approved for trading within the next week, which would be a really good catalyst. So just to finish off, just talking about crypto, a couple of headwinds, couple of tailwinds. The headwinds right now, the biggest things are, Germany have been dumping a lot of Bitcoin, but it hasn't really hurt the market because the Bitcoin spot ETFs have been buying again. And all of the dumping through the Germans have actually been absorbed by the Bitcoin spot ETFs buying. So it hasn't really been felt at all. We got Mt. Gox, and Mt. Gox is $9 billion worth of Bitcoin and Bitcoin Cash that's being sent back to people that lost it 10 years ago. Now, there is a chance that those people that might have held 100 Bitcoin that wasn't worth more than a couple of grand back then and are suddenly instant millionaires and they might sell. There's also a chance that they were early adopters into crypto. They've stayed close to crypto and they know the cycles and they won't. So we'll have to see how the Mt. Gox works out over the next few months. The tailwinds is the FTX is coming up for final voting on distribution. Altogether, there was $11 billion of customers' money that was lost in FTX. There's $11 billion worth of money to be paid out. The good news is that the liquidators have actually increased that to 15 billion. So most customers are not only going to get 100% of their fiat money back, they would have preferred to get their crypto back because it's worth a lot more than it was a year and a half ago. But they are going to get about between 114 and 140%, depending on the customer and depending on a whole lot of different factors, of their fiat money back. Now, the good news is if that's $15 billion coming back to crypto customers in fiat, it's more than likely going to be deployed as soon as possible into crypto, especially considering that it's going to be paid out sort of October, November this year. So we got that as a tailwind. We've got presidential elections, a tailwind. We've got rate cuts imminent as a tailwind. So we got increasing money supply, M2 money supply. So there's a lot of liquidity tailwinds coming. What we do expect, though, is between now and October, November, that will still be sitting in a bit of a consolidation, a bit more risk possible, right? So we don't know quite what to expect over the next quarter, the next 3 to 4 months. But going into the end of the year and the start of the next year there should be a lot of tailwinds helping crypto and equities. All right. I'll open up for any questions or comments. Feel free to, I'll scan through chat, but if anyone's got any questions or anything else, just fire away.
Just Craig, the website to get the earnings forecast through on the earnings calendars and that for the USA stocks and that. What do you use for that, mate? Sorry again.
So the earnings forecast. So the two I use is investing.com and Tiger Trade. So I use Tiger Trading, and they've actually got a really great app. And they give you a hell of a lot of detail about all the earnings coming up and forecasts. The actual calendar
Excellent. Thank you.
I get from Earnings Whisper.
Beautiful. Thanks, mate. Ciao.
No worries.
Right. Just on a macro level, I know sometimes listen to Paul a bit. He mentioned that around the Fed sort of really want those interest rates to come down because they refinance all their debt every 4 years and it's coming to that point.
Yep.
And they really want it to come right down. So when they get to refinance it, clearly that's better for them. Is that sort of valid from your perspective? Or?
Yes, 100%. So the US government debt is at astronomical levels. If you just Google debt clock or US debt clock, And you actually look at, it's got a great dashboard of all the debt that the US is sitting with. And it's absolutely scary in terms of the government debt that they've got. Now, if you think about what they sort of paying, they're paying more on interest repayments of debt per year than what it costs them to fund the entire military for the year. So debt is a really big thing for the US government. So absolutely, they need to refinance it, and they need lower interest rates to refinance their debt. So there's a significant reason why the US government want the Fed to cut rates and cut rates fairly quickly. You know, the Fed cutting rates, I think if they started this year and they started before something significantly broken, there's a I had also prepared this chart. This is a chart I look at all the time. This is the US 2-year over US 10-year bond yield. So this is the bond yield, the short-term bond yield over a longer-term bond yield. And what it means for bond yields to invert, it means that it's currently the interest rate of the 2-year bond is higher than the interest rate of a 10-year bond, which is ridiculous. If you're tying your money up for 10 years, you should be rewarded better than if you're tying your money up for 2 years. And there's periods in history that this is inverted. So I've got this line at 1-to-1. Every time that the 2-year is below the 10-year, it's below this line, and that's what we call healthy. And when it's unhealthy, it means that something's broken, is when the 2-year interest rate exceeds the 10-year interest rate. And we go into these periods of inversion on bond yields every now and again, but we've never been inverted for as long as what we've been inverted for 700 days already. So we're coming up to 2 full years of being inverted on bond yields. But historically, what has happened is when bond yields uninvert, there is a period of a significant recession. And what I've got under here is this S&P 500 and the performance of the S&P 500. And I've highlighted the period that's followed the uninversion and the period that the S&P 500 went into negative territory. They had a massive big dump, and some of them lasted an incredibly long time. So this is normally a recession marker, that when we see an uninversion, that there is a significant recession that follows. Now, the recession doesn't happen immediately. It could take 6 to 12 months from the uninversion to when the recession starts. But when we start looking at some of these major recessions, we're talking the 2008, 2009 global financial crisis, the GFC. You know, that was the big one. We talk in the big tech bubble, the 2000 to 2022 crash. Right? This was the COVID crash, so maybe that, you know, we can treat that as an exception. You know, this one back here was 1990. But the two big ones that we suffered was the 2000 to 2002 and the 2008 to 2009 GFC. And what this would be indicating with this level of inversion is that we have another one of these coming, as big as the 2000, 2002, as big as the 2008, 2009, right? We have one coming. When will it come? Well, we don't know when it will come, but it normally happens 6 to 12 months after that uninverts. So if we start the rate cutting cycle in September, that could uninvert in October or November or December or January next year. And then the clock starts ticking for a major recession that will probably hit us globally, something similar to the GFC. And we're expecting that to hit us probably in 2026 and last a couple of years, 2026, 2027. So great opportunity. We're in the sort of everything bubble at the moment. We're going into, as rates start being cut across the globe, we're going to go and see a massive boom in property prices, right? Because people can afford to buy more expensive houses if their interest rates on their mortgages are lower. So as rate cuts happen, that will fuel the property market for the next sort of 12, 18, or 24 months, take us through to about 2026 as a what they call the winner's curse of the property cycle. We expect cryptocurrencies and equities also to have a really good year in 2025, being the first year term of the president is always really good. All his new policy changes are always favorable. He does all the nice things that everybody loves. Everyone's in a good mood. It's really lucrative for markets. It's year 2, year 3 in the cycle, things start sort of tapering off. So everything points to the Q4 2024 and 2025 being incredibly good, but then we are going to be faced with a hell of a headache at some stage, which will probably be 26, 27. So at this stage, those rate cuts, we've often seen that when the Fed cut rates proactively, which doesn't happen too often, the markets do respond really well. If we look at market history, in terms of, I did have a chart here. Here we go. So if we look at, let me just pull this clear. So if we look at this chart over here, this is taking the S&P 500 with Fed cuts. So dates from the first Fed cut, 100 days out, 200 days out. Now, we had the 2000 to 2002, which I was talking about, and which is the darker green. We had the 2008, 2009 GFC, which is the lighter green. The yellow was the COVID crash, but all the rest have actually been incredibly positive. So when we look at the average is the S&P 100 days out from the first cut sort of averages 5% up, and averages about 10% up 200 days past the start of rate cuts. So we definitely see that unless we go into a recession, and that's normally when the Fed react too late and they do too little too late, and the damage is already done, that's when we start to see negative performance in the S&P 500 following rate cuts. But what we should see is if the Fed do start in the next month or two, and if the Fed just do a 0.25% cut at a time and do 2 or 3 consecutive cuts, 0.25% at a time per meeting, and they don't meet every month, they meet 8 times a year, not 12 times a year. So if they do a rate cut, a few consecutive 0.25% rate cuts, then have a break, then do another couple of, it should actually be incredibly healthy catalyst, and it should mean that we have an incredibly good 2025, but that inevitably will follow with a major recession probably in 26. So we definitely got some time on our hands, and we definitely have the opportunity of seeing markets continue to perform incredibly well for another 12 or 18 months. But then we will be heading into some significant pain. All right, what else have we got? There's not anything else. I think we'll call it there. Any other questions?
Sorry, one question from me, Jake here. When the 2026 does come, maybe it's a little bit premature, where do you think it's best to hide, I guess, with currencies and sort of inflation and stuff like that? Any tips or thoughts?
Yeah, it's something that's really good to think about. There are going to be some asset classes that perform better than others, but historically, when we start to see significant pullbacks where everything gets hammered, probably the best place is to have it in cash or somewhere that you can access it, because the biggest people, so some people lose significant money during global financial crises, but their opportunity to make and create wealth, if you are out of the market, ready to step in when the time's right, and if you know when the time is right and you invest at the bottom, those recovery bounces that happen are phenomenal. So we talk about lost decades in trading, and a lost decade means that when you have a significant pullback, it can take you 10 years to get back to where you were. And that's what pretty much happened in 2000. That's what pretty much happened in 2008. And when you have these sort of lost decades, there are stocks, there are sectors, there are asset classes that take almost 10 years to get back to where they were prior to the crash. The beauty comes in terms of the wealth creation, is not being in when it crashes, seeing the early signs, getting out before it crashes, and then having the money to deploy once it's bottomed. And it could mean you're out of the market for 12 months. It could mean you're out of the market for 18 months. It could mean 24 months. But having the tools, having the experience, having the insights, and having the connections to along the way to know when the right time and what the right sectors to go into are. So everything works in a cycle. And currently there's always asset classes that are going to be incredibly expensive. And we're starting to see a lot of the mega caps getting into that area in the S&P 500. And the S&P 500 looks like it can't be sustained much longer. But if investors start to go into the mid caps, into the large, well, in the S&P 500, start going into the other 490 stocks other than the top 10, you would start to see that being more sustainable. So the biggest opportunity in stocks, if we carry on in this bull market, when liquidity starts coming in, the opportunity is not going to be the mega caps, because the mega caps have been running really hard for the last 18 months. But all the Russell 2000, the RWM, is sitting at really low levels, and their forward PE ratios are incredibly low. The stocks are cheap at the moment. They're really cheap. So as soon as we start getting that confirmation of that liquidity cycle, the next liquidity cycle starting, which should all start in Q4 this year, that becomes the opportunity to start coming out of the stocks that you're holding of the mega caps that have been performing and going investing into the smaller caps. The other big asset class variation is equities versus commodities, right? And when you look at throwing your total equities versus your commodities onto a chart, and you're looking at the ratios and right now, the money that's probably going to get made in the next 18 months is more going to be in commodities than equities, because commodities are extremely undervalued compared to equities right now. So these are all opportunities. In the market, the beauty about it is there is always somewhere to invest. There is always somewhere to put your funds. There's always somewhere that's going to give you great returns. It's just being on top of the market and identifying those rotations and getting into, ASX Trader he's got a lot of really good sayings. I try not to blow smoke up his ass too much, because every now and again he pumps out these really awesome analogies, and I go, wow, that's really good. But the one thing that he uses quite often is, don't skate to where the puck is, skate to where the puck is going to be. And that's what trading is all about. It's no good going to what's pumping now, because you're too late. People have already made the money. That's where you're going to get burnt, right? Look at what sector you want to get into. What hasn't gone yet? What is starting to show the really right formation? What is starting to show those reversal patterns? We spend 10 weeks just identifying when to get into stocks, when to get into sectors, when to get into, how to identify trend changes, how to all the different reversal patterns that you need to look at, and then looking at all the different areas of confluence that you can use to back up your decision. And all of these things are so important in terms of arming you to make the best decisions of where you want your money invested, and where getting out in time of something that's already run, and getting into something early and enjoying the whole ride up.
Thank you so much for your time. I'm sure I'm saying it on behalf of many people, but I'll let pass it back.
Yeah, you're welcome. You're welcome. Well, thanks everyone. I hope I've scanned through. Is there a typical of a short? I will go through the comments if there's anything I haven't. Do I use Elliott Wave? I use Elliott Wave a hell of a lot. I do have a page that's mainly focused on Bitcoin. It's called Craig's Bitcoin Buzz. So if you're very interested in crypto and specifically Bitcoin, feel free to follow my page, Craig's Bitcoin Buzz. Just put MTM when it says who referred you. Just put MTM so I know it's one of you guys, and I'll accept your application into that. And I put posts there all the time, and I use a hell of a lot of Elliott Wave. In the MTN course, we do spend the whole of term 3 on Elliott Wave.
Hey Craig, where's that page at? I'm sorry I missed it. I want to find out where to follow you.
Yeah, Craig's Bitcoin Buzz. Let me pull it up here quickly.
Is that on Facebook?
On Facebook, yeah. So let me.
Okay, thanks.
There we go. Hopefully you can see that. There we go. Craig's Bitcoin Buzz. So that's my group. That what I do is I keep my Facebook profile as sort of friends only, and I don't sort of post any trading or crypto stuff under my own name. I post everything into my Facebook group. So feel free to jump into the group, and you'll see everything that I put in there. And drop me comments. Don't be shy. If you want to ask anything, if you want anything, if you want to see anything in particular around stocks or sectors or anything else, just ask me in the Facebook group.
Awesome. I really appreciate it. I've been up. I'm in the US, so I've been up since 5 a.m. waiting on this call, and I got a ton of value. So I really appreciate you and ASS for this.
Fantastic, Isaiah. Thanks so much for the feedback. Thanks for getting up so early. All right, everyone. You have a absolute awesome evening, and if you are thinking of joining MTN and you got any questions, just shoot us. Just engage either ASX Trader or myself on anything that you want to know, and we'll talk you through it. But we'll be happy to have you on board. See you guys. Bye.
Thanks, Craig.